first and foremost, what we like to do planning and scanning, kind of review a few things. We've got some lines in the sand, bunch of stuff that we talked about. Friday, first and foremost, what we've been talking about is a close, a breakout above the swing high. We needed to see increase in volume, which we did get. Friday, one of the biggest comments that we made was, we close underneath the green line of support, then we probably come back down and test this black line. And what the comment was is that don't get caught short down here, because many people chase short markets. A couple other little things that we were looking at is this engulfing Marabuzzo candle. Generally, typically 50% in the mid-range acts as resistance, which on Friday when we had our mentoring class here, we actually did look at this as a target area of resistance. Time of day was right in the lunch hour, but it did offer a nice little scalp for approximately 4.5 points, not a big deal. But then all of a sudden, when we got back through and we noticed that the market was starting to accelerate to the upside, we started to see an upside in volume. Now, for the record, this is the planning and scanning session, and also we have an open house week here. I'm in the room generally from 9 to 12 noon Eastern, 9 to 12 noon. Partly what we cover in this room: equities, options, futures. I do not talk all day long. I couldn't stand listening to myself all day long. Can't expect you to do it either. What I also like to point out is areas in which the market may find buyers or sellers, points of breakouts, energy. In other words, sometimes the market just sits and sits and sits, and then when something happens, you always notice that that's that inflection point, that energy or momentum comes into the market. And that's some of the things that we like to analyze and to provide, not just for day traders, but also more importantly for equities, stock traders, as well as ETF, and which obviously we can apply options to. So that's the general gist of what we do. And what I like to go through is to follow up with, you're only as good as your last trade and your last market analytics. So with that said, let's get started into, now that I've given people an idea of what we do here, what my time is that we stay in the room. Let's talk about the market condition as we now enter the fourth quarter. Members should have received yesterday my weekly thoughts and observations. On a side note, many of you are not familiar with this, but in the trading room, for example, if we've discussed in the morning session, if we've discussed things where I'm scanning for things in the afternoon, a couple things that I will point out is, for example, that 1929, 1930 handle, watch for closes above that level. But I also like to point out, anyway, this might be just too early in the morning, but anyway, I'll let you figure out what that is. Once in a while, I throw out something that I think is kind of a keen observation and funny in life. But other than that, it's mainly what we talk about in the market, different stocks. We had on September 24th, high close dojis, Netflix, Fizz, Soda, and pretty much that whole sector. And what we've been talking about up to this point is there's been Netflix, Fizz, Soda in the consumer restaurants and the consumer sector. We've also seen some really big moves. We also look at low close dojis, and then one in the restaurant sector we've been talking about is Zoes. I got corrected many times because it's Zoe's, and I don't know. I just don't pronounce things correctly, but I know the stock symbol and I know what the triggers are to mean. So we've been actually putting out some pretty decent stuff in the market and in tweets and looking and recognizing particular setups. So if you're not familiar, we do follow up with tweets there. A couple of other items to note. This is a red candle, that last conditional change. We had daily high close dojis followed by a buy signal, and again, this was Friday's price action, and we did get that market on 60-minute close over, and we had follow through to the upside. So what's my prognostication from here? In prior weeks, I've been claiming that I think at this market we have a cycle low that was due the week of October 9th. That's this week. A cycle and a seasonal analysis. For visitors here, I'm not going to get into that cycle analysis. It's just not worth getting into because it would take too long to explain. But what we look for in, and many of you are familiar, so I'll give you credit there. A lot of you are familiar with cycle research, cycle analysis. Pretty much it's a timing event, and just, you go back in time. An article that I'd written in an ancient article 13, 14 years ago in Futures Magazine combined the 11-week cycle with pivot point analysis, and how we see a lot of different forms of technical analysis coincide, corroborate, and is great confirming information. So armed with a little bit of seasonal analysis, armed with a little bit of technical analysis, and technical analysis, not that this is an open house for teaching, but a couple things that we like to look at is the condition of the market, and forms of technical analysis include a variation of volume analysis, and when we look at equities, we like to look at breadth analysis. Also, I kind of take a gander of looking at the amount of stocks that are above and below in the S&P 500, a couple other of specific moving averages, and I will share some with you right now. So, coming into today, we had a numerous amount of daily high close doji triggers on individual daily stocks. And I generally like to follow up with what we wrote about and sent to our members yesterday. That way, a lot of our members have kind of like a heads up before the week even begins. Okay, so with that said, how many stocks are above or actually below the 50-day moving average? That's kind of, and we've had an enormous amount of stocks within the S&P 500 below their 50-day moving average. I mean, you could start from up here, Agilent Technologies, even American Airlines, which to me was a surprise considering the fact that the airline group had been performing relatively well in this little downdraft recently. But Apple is another one. Apple is one that we've done extensive studies with. This little PPS sell signal also marked what we call the last conditional change. We weren't too convinced that the market was ready to pop. We needed to see it close over that line. Also, we had this low right here, which was acting as support. And so one of the things that we talk about is that Apple and other names in the group under their 50-day moving average, we almost had the potential for an inverted head and shoulders bottom. The timing element, this thing needs to rock and roll, and it needs to break out. If this is an inverted head and shoulders pattern, the symmetry is being diluted. The amount of time that a head and shoulders inverted or regular, the amount of time that we create a left shoulder should be symmetrical for the time that it takes to create the right shoulder, and then you should see the ensuing breakout. At this point in time, this is going to turn into a different pattern. It's not conforming to the inverted head and shoulders pattern. When I switch to a weekly chart, by the way, on Apple, we note that last week we generated a weekly sell signal. Not a warm and fuzzy feeling for those interested in upside momentum. Ironically, Apple has a seasonal tendency in its history to bottom on or about the first week of October, generally because it's a product launch. This year might be different. We mentioned that because they came out with the product launch of the iWatch. Personally, I don't know if the iWatch is as popular as what they think it is or thought it would be. I'm not sure. Those that do have it love it. Those who don't have it aren't convinced. And there's more of those who don't have it than do have it. And so it's not the greatest of product launches. I'm not here to analyze the fundamentals. I'm not here to tell you how good or bad the product is. I'm just looking at the analysis and the charts, and I do not see a lot of, even week over week, a lot of sustaining volume coming into this market on these rallies. So it's going to take, this is not a stock that I want to buy here. I don't really want to sell it because of the seasonal tendencies of the market, but I will tell you that we do now have a new last conditional change, and it is above the high of approximately, as you can see, I'm just trying to put that blue line in there. Let's call it 114 for practical purposes. And if we do get a daily close over that 114 or this week, which is one of the things that I kind of commented on early in the week, we had a doji, we have within 3 days, a potential high close doji, we need to see an uptick in volume. But if we get a daily close, by the way, over this last conditional change candle, we're going to get another little thing that we call the trilogy setup. A couple things have to happen: a buy signal, a trend line break, and a last conditional change. If you don't understand the last conditional change or any of the terminologies we're saying, not important right now for visitors. It's all in you can go to Amazon and invest $39 and buy a book and read about it. It was something I wrote back in 2004 in the Candlestick and Pivot Point Trading Triggers. It's on page 264. So it has been around a while. Not to be flippant, but it has been something that's been around a while. And it's very, very intriguing because it's been an incredibly effective candle and isolating points of breakouts and as well as points of support and resistance. A lot of times markets will come right up to that last conditional change high candle. It'll act as resistance and then fail. So until we actually close above that level, it becomes and acts as resistance. In essence, looking at the spider, the ETF, and we'll get to that in just a second, but I'll share with you right now, on the spiders, we actually, the resistance, that little red candle, it acted as resistance, and then all of a sudden we've blown through it. So it is a good area it's a great candle to identify support and resistance. I'll just leave it at that. Anyway, in the meantime, what is the condition of the market? And we look at breadth and we look at a few other things. More stocks are coming off of their 52-week lows. More stocks are coming back above their 50-day moving average. That's positive for the market. We want to see a consortment of stocks, a consolidation. We want to see a congregation, strength in numbers, start to get above their 50-day moving average. If you see here how many stocks are below the 20-day moving average, you'll see it's 249. So in the S&P 500, if we have literally half 249, then we ought to have more than half. And I have cheated and used a criteria search here to find out how many stocks in the, let me change this back. I wanted to find out in the universe of 7,000 stocks, how many are above their 20-day moving average. By the way, 3,100 are above their 20-day moving average. So we can just change this back to S&Ps, and the answer is going to be, we're probably going to see in the S&P 500, close to half are now back above their 20-day moving average. So more stocks are becoming less negative. That's a good thing. More stocks are becoming less negative. So the question begs, is this the crash of 1929? We've been taking the outlook. I've been taking the outlook that no, this is not going to be the crash of 1929, at least not yet. We need further evidence. And as you can see, looking here, 246 stocks are actually above their 20-day moving average. So roughly half the stocks are below and half the stocks are above, and that's even Steven. So how do we make money with this information? Well, number one, it tells us that if we have a thesis that this might be the low and we have some buying opportunities in the marketplace, we want to make sure before we put money to work, and there's tons of ways to trade the market. Selling put premium, you got your option writing crowd and you've got your directional crowd. I've always found it to be more of my work, I've been more directional, and I think we've had better success at that because of the timing element of the market. The other day, noting, as you can see, this is our everyday charts. Are we in a wide range trading range? And it looks like now the answer might be yes. This weekend, I said we're not seeing a V-shaped recovery, like a V bottom, but more like a U-shaped. And more importantly, here's something I want everyone to kind of focus. I was saving this for today. We might form a potential. This is kind of wild. I mean, something that we technicians and traders dream of. Is this a potential W bottom formation? So what we want to see now, we've broken out of a downtrend. We've broken out above the last conditional change. We've had a daily high close doji. The only problem is that we're in a monthly and weekly sell mode still, and that will change if we see maintain higher closes, especially above the 1960 area. That was, we joke in this room, my birth year era, you know, into the 60s, and then we get into the 70s again, the 80s, et cetera, et cetera. My premise is I think that the stock markets are all going to go back on positive on the year. You know, wishful thinking, I don't think so. We have some pretty significant analysis that suggests upside momentum. And I'll share that with you. Last week, we did see a breakout in the AD lines to the upside on a daily basis in the S&P 500. For those that don't understand breadth analysis, this gives us a cumulative tally in the S&P 500 of advancing stocks versus declining stocks. So in an essence, when a market makes new highs and you see divergence, then you get a relatively strong idea that the market is going to go down. When the market does go down, but not all stocks go down, and you start to see a reversal, we kind of get an idea that there is accumulation both in strong volume and the amount of stocks moving higher. So my premise is I think, you know, for the S&Ps to get back positive on the year, we need the spiders to get to 205 by, you know, the end of December. You know, even if I'm wrong and we go back to slightly unchanged on the year, that to me is a kind of an easy call. Last week, we identified that the diamonds, the Dow Jones Industrial Average, was the best of the worst. In fact, we actually had, even though there's only 30 names within this index, we had an accumulation and a bullish convergence in the AD lines, and we started to see that the Dow started to outperform the rest of the market. So the diamond's looking pretty healthy here on a daily basis. This is what most traders, as you know, guys and girls, ladies and gentlemen, most people get the information of the New York Stock Exchange, NYSE Composite Index. And when you look at the NYSE, not only did we come close to weekly person's pivots last week, little high close doji ensued, but you had your unemployment report to contend with. We did see an uptick in the AD line. What I don't like, and put all my eggs in one basket and look at this pattern, is that, you know, there's about 1/5 of the stocks here are foreign companies, number one, and over half the stocks in this are interest rate sensitive. So while even though that the AD lines did improve, I am more impressed in the fact that the volume analysis improved substantially better than the price action improved. So when the last time we were at this high reading on the volume analysis, prices was, you know, way up here a little bit. So this insinuates that we have a little bit more upside. There's a gap up in the market, and that's the NYSE. So obviously we walk in here and the market's up, 13 handles in the SPOOs. What are we going to see here? I think that this could be a situation where we get, like in 2011, we had the market when it puked out here, even in 14, you could take a look, 1, 2, 3 weeks straight up. It didn't really give a chance for people to identify a pullback. And I think that might be kind of the consideration that we need to respect this week. And so the volume on a weekly basis, the volume on this downdraft, I don't know if we've been kind of following this, and I don't want to get, you know, too excited, but the fact is that this volume analysis, this sell-off was, I mean, one of these days, this could be the biggest joke to humanity, and we might see this market recover a lot faster than we think. The worry is that the participation rate of the amount of stocks that went down was pretty significant, but the volume was very light on this move. And we've been saying that for quite some time. Which indicator do you believe? The breadth or the volume? So for me, I think we kind of anticipated to see a downdraft in July. We had a cycle high due. We were calling for either a 5 to 8%, or we were going to see the 15 to 20% range. We got almost the 15% range sell-off. Now where do we go from here? I think it behooves us to explore the fact that the market, for me, is going to see a recovery for year's end. What would change that opinion? What would change? So that means call options, writing put options, bullish strategies. What would change that opinion for me would be to see a weekly close underneath last week's lows. Last week's low was a benchmark tell. It really was. It was about the average of not the extreme capitulation low of August 24th, but last week's lows showed a key reversal off, sentiment, timing element. Timing element meaning we were coming into the 1st of October, the seasonality, and last week's low really had an impact reversal and follow through. That's the key, follow through. And it was one of those things where everyone's student body's thinking the market's going down and a key reversal to the upside. So for me, closes underneath last week's low, then we got some big trouble ahead, big trouble ahead. As it is right now, you can clearly see that even the volume analysis, we had this huge convergence. And right now, look, as I mentioned earlier, if, again, it's Monday, so we got to take this one day at a time. But Monday, we're going to, look where we are in pricing, 1956. We have an indicator flashing that if we close here on Friday, we will generate a weekly buy signal. And therefore, I think that's that kind of U-shaped bottom I wrote about and just wanted to share with you. That's why I don't see a V-shaped bottom, but that U-shaped bottom. I don't expect to see the market get back to, if anything, for this particular week, I'm going to be focused on pullbacks using the weekly person's pivot analysis. And I don't know if the market has the capability of even getting back into that 1920, 1925 handle. So if the market is truly going to see a reversal, the next area of resistance to watch for a breakout point is going to be right here, which is 1968. 1968 closes over 1968. It's going to want to hit 2012. We hit 2012, and then, believe it or not, this might take time going into November, whatever, 1st of December. But that's the kind of outlook that I see for the market. Strengths in sectors. Let's take a look at the different various stock indices here. A, NASDAQ. The volume actually had a nice little recovery. The AD lines had a nice little recovery, and so did price. Once again, we're going to be focusing on not just a close above that swing high, but closes above this last conditional change, 43 double nickel, 43.55, closes, daily close over that level, and I think this thing's got, some upside. So, and legs. And I'm not saying that, because we got follow through. I think the key here was to look more at the bullish patterns. And there just were a bunch of positive names and positive things out there that we kind of were looking at. In this week's market analysis, which I will log in and share with the visitors for this week after this recording. But may I point out, this week we got FOMC meeting announcement. This week we've got a lot of economic numbers, except for perhaps for ag traders, we've got the monthly crop production report. But I think that if anything, the Fed minutes, after that last employment number, that kind of put the kibosh on any type of rate hike going into October and even, I think, the next 6 weeks out. Remember, the Fed meets every 6 weeks, so that would be the first, second week of December. Any event, I think that right now going forward, the best look for the market is for upside in some of these seasonal areas that do change. And so some of the things that enter a seasonally strong period of time that I would like to say, a lot of people come and they visit, and a lot of people only come for planning and scanning. But I want to take a look at, as I've just shared with you, what does the health and the breadth of the market look like? And it looks like we are seeing a somewhat of a recovery, as everyone can see, except for the NYSE. The NYSE isn't open yet, so when we do open, we want to see if, as every day goes by, and Tuesday after about mid-Wednesday, if we see a pop in the AD lines, in the weekly NYSE. This is the sector that has about a weighting of about, what, 20% to healthcare? And the funny thing is, look at this volume tool right here. It almost looks, if I lied to you and said this was a price, it looks like you can continuously see almost higher highs and at least a higher low, which is convergence. So if we get price move up with acceleration on the advanced decline in the NYSE, I guarantee you there's going to be a lot of people, and what's going to cause that sector or that index to go up? Since it has 20% strong weighting to healthcare, let's take a look at seasonality on healthcare real quick, because that might be the surprise that we get strength back into the market. I just saw for the very first time on commercial yesterday, NyQuil commercial. I haven't seen one all summer. Coincidentally, no one ever gets sick in August. You know, you don't get people that call in sick with the flu in August, but kids go back to school. It's cold and flu season. Chicago Bears barely won a game yesterday, I noticed. And in the seats, fans were wearing scarves and hats and gloves. So it is getting cold up north, that's for sure. This is my relative strength analysis chart. 2 weeks ago, we had a few names, a few sectors that were positive. As of last week, talk about strength in numbers concept. We had 7 sectors. We now have 7 sectors that are positive on the week. Or not just the week, but positive on the year-to-date move. That's impressive, okay? So there's an awful lot of other sectors that are about ready to pop positively. What are those sectors? This heavy blue line is XLK. This black line is XCI, which is technology, hardware index. So we are starting to see some movement here, and as you can see, we've got, man, this is one ugly beast. This is the XOP. XOP is only down 25%, let's call it. This is, of course, the XLE. We've got other sectors like the materials, which XLB. Materials, which is very interesting, and this is what I wanted to point out to you. This is actually one of the best time of the year to focus on material stocks. It's way oversold. It's not a leader by any stretch of the imagination. But, you know, it's kind of ironic. You get a lot of these ag names, Monsanto, for example, that haven't really performed very well. So stock traders, it's maybe you're going to sit there and say, John Person, you are crazy if you think I'm trading Monsanto. Well, that's not the point if you don't want to. I mean, I'll trade it if I got a great buy signal. But what I will use the information for is to see if the plan is coming together. If institutions are going to come back into the market, the stocks that got beaten up heavily. I mean, I'm not saying that Monsanto's looking like a real charmer here, but I mean, it was near $125 back in April, and it was down to near 85 last week. So it is one that obviously had been, as with a lot of stocks, gotten taken out to the woodshed, so to speak. So if we see a recovery in some of these sectors, it's showing to me that the more sectors that get positive and cross that zero line, the more sectors that go positive, the better it is for the overall markets to see positive gains going into year's end. The worst performing sector to date is, of course, the Dow. It's down the most. So we are starting to see strength in numbers come up. We are starting to see equity markets start to conform as far as not crashing. And interestingly enough, we had a numerous amount of names in actually technology start to pop to the upside. Also, I want you to see this one little, it's hard to see, it's olive, this little olive. It's up 2% and it's going up, and this is biotech now up 5%. While we weren't too positive on biotech earlier this year at all, I'm starting to get more positive on the biotech and back again, and I'm starting to get more positive on healthcare. So I want to see two things, and I would say if you believe in strength in numbers like I do, it's not just about price, it's also about time and price. The longer these sectors maintain their positivity. The longer these sectors, and especially healthcare, remain positive over the next couple days and into by Friday, and if we start to see their changes making higher highs and higher lows again, guys and girls, then I'm a little bit more convinced we've got an end of year rally back to unchanged, if not higher, believe it or not. So that's kind of looking at one other area that I wanted to share with you is this little doohickey over here. This is actually the Mcclellan Oscillator, and this is a daily chart, something that we went over this in our room together last week. We see this almost W bottom formation. We won't get the breakout until we get above the swing high, which was September 16th. You get closes over there, that's looking pretty promising. What is this black line? It's actually the spread between the NASDAQ and the ES with the moving average. So if we are to see a recovery in the market, we want to see that black line, the percent change of S&Ps to NASDAQ. We want to see this black line get more positive. Also, looking at the weekly Mcclellan Oscillator. All right, looking at the weekly Mcclellan Oscillator, we were oversold. We were forming a convergence. We were looking for this market to start to pop, and it has. That's pretty strong move in 1 week. While granted we are not crossed above that zero line, the weekly Mcclellan Oscillator is also showing that there is strength in numbers on a cumulative basis from week to week. So for those traders that are interested in directional, this is not the time to be. I think it is more of a time for bullish strategies, and we'll talk about those strategies this week, and especially as we carry on. But I thought it'd be nice at least to go through top to bottom, stocks to watch for the week, sectors to watch for the week, and what we are looking for. That concludes our planning and scanning what the condition of the market really is looking like. As a reminder, we are here all week with you guys.